All right, it is November 3rd, 2025. The market is caught in a classic tug of war. You've got a geopolitical tailwind fighting a domestic headwind. We're going to cut through all that noise, break down the key levels, and find the actionable setups for the week ahead. So this is the whole story right now. You have this powerful catalyst from the China trade deal smacking right into a brick wall of domestic dysfunction from the government shutdown. The key to making money this week? Figuring out which one of these forces is going to break first. All right, let's get into the specifics. There are three big news items pushing the market around today. First, the tailwind. We got a new one-year U.S.-China trade deal signed November 1st. NVIDIA's CEO is already saying this could reopen their China market. That is a huge risk-on signal. But fighting that is the headwind, the U.S. government shutdown. Fox Business reports it's hitting 42 million people on SNAP, 13,000 air traffic controllers. That is a direct break on the economy. And finally, the wild card. The Supreme Court is hearing a major tariff case, which just throws this massive cloud of policy uncertainty over everything. So you've got a clear positive, a clear negative, and a giant question mark. Okay, so enough with the headlines. Let's look at the actual data. Because the risk gauges, they're flashing some pretty serious warning signs just below the surface. So look at the VIX. It closed at 17.44, up over 3%. But honestly, the absolute number isn't the real story here. The trend is the VIX is making a series of higher lows, even with all the positive trade news. That is a critical divergence. What does that tell you? It tells me that smart money is quietly buying protection under the surface. They are not buying this rally. And looking ahead, man, the calendar is just packed with potential volatility events. We got to watch for any news on the shutdown talks midweek, Palantir earnings. That's going to be a big tell for tech sentiment. That Supreme Court ruling is still hanging out there. And all of this is building up to the major options expiration on November 21st, which you know is going to act like a gravitational force on prices all week. All right, let's zoom in a bit. We've talked macro, now let's drill down to the one sector that is right at the epicenter of this entire conflict: semiconductors. Okay, so NVIDIA is the most direct play here. If that market reopens for them, it's a massive revenue catalyst. Simple as that. Then you have Taiwan Semi, TSM. They're the classic picks and shovels play for the entire AI cycle. They make the chips for pretty much everyone. And Applied Materials, AMAT, benefits from the global push to build more fabrication plants, which is a direct result of all these reshoring efforts. These three names really tell you the entire story of the sector right now. And check out this quote from a Fox Business commentator, because it just nails why this sector matters so much beyond just quarterly earnings. This isn't just about technology, it's about geopolitical power. This competition for AI and semiconductor dominance is the new oil that ensures government focus and funding for years to come, which is a massive long-term structural tailwind. All right, before we get into the scenarios, we have to do the mandatory disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, so with the drivers and risks laid out, let's build a framework. Remember, we are not here to predict. We are here to prepare. And that means having a base case and solid plans for both the bull and the bear scenarios. So, what's the key question for the week? It's which of these paths has the highest probability? Let's break down the specific triggers that'll tell us which way the market's really leaning. For the bulls to take control, you need a 3-item checklist. 1, the trade deal holds and the language stays positive. 2, the VIX has to fall back below 17. And 3, a quick resolution to the government shutdown. Now, the bear case? It's the exact opposite. The shutdown drags on, talk around the trade deal turns negative, and most importantly, the VIX breaks and holds above that key 18 level. So here's the bottom line. The base case is for chop. These conflicting catalysts are likely to keep the S&P pinned between 6,800 and 7,000, with the VIX stuck between 17 and 18. The posture for that scenario is to stay delta neutral, don't have a strong directional bias, and hold at least 30% cash. Now, if those bull triggers hit, a break above 7,000 is your signal to get long. If the bear triggers hit, a break below 6,800 is the signal to get short or just move to cash. Okay, now let's translate all this analysis into 2 potential option structures. And remember, these are just educational examples of how you can express a view on this market with defined risk. First up, a debit call spread. Look, this is a very capital-efficient way to express a bullish view. It allows you to capture upside from a catalyst while defining your maximum risk right up front, which is absolutely critical in a market with this much uncertainty. You can apply this directly to NVIDIA. A debit call spread expiring in December would be a clean way to express a bullish thesis on the China market reopening. Your risk is defined, the catalyst is clear, and the invalidation point is simple. If the trade deal narrative falls apart or the stock breaks key technical support, the thesis is wrong. You get out.
Second idea, the iron condor. This is a neutral, range-bound strategy. It's designed to profit from time decay and a drop in implied volatility, making it a perfect tool for playing high IV events like earnings when you don't have a strong directional bias.
Palantir's upcoming earnings is a perfect candidate. Implied volatility is elevated, so options premiums are rich. A weekly iron condor lets you bet that after the initial earnings move, the stock is just going to get pinned and consolidate around that key $200 level. The goal is to collect that high premium as volatility gets crushed. The trade is invalidated if the stock makes a massive move, blowing past either your short put or short call strike. Simple as that. All right, let's wrap this up by summarizing the key levels to watch. Think of these as the signposts that are going to confirm or invalidate the scenarios for the week. For the S&P 500, support is 6,800. That's your first target on a pullback. Resistance is the 7,000 level, which is a huge gamma magnet, so it'll tend to pull the price toward it. For the VIX, a sustained break above 18 is your primary risk-off warning. And you know what? Keep an eye on Bitcoin. It's acting as a broader liquidity gauge, and a breakout above 120,000 would be a powerful confirmation of risk-on sentiment across all asset classes.
And the final disclaimer. This is not trading advice. It is just a market update to keep you informed. Markets carry risk. Trade your plan, manage your downside, and verify all your data.
So, I'll leave you with this question. With government policy creating both the biggest reason for optimism and the biggest reason for caution, which one is going to win out? Is the market today driven more by the hope of geopolitical stability or the reality of domestic dysfunction? That's the puzzle we have to solve this week.